Good morning, guys. We're trying to reverse 4 days of declines, and it's a good start. 8-1 advancing to declining stocks. That we haven't seen that in a while, so that's good news. But we're already off of the highs. So the problem is there's not a lot of buying enthusiasm for the moment. Selling pressure might be exhausted, but nobody is enthusiastically buying. Let's take a look at the sectors. What you can see is a very small group of people that are trying to buy the growthier sectors. This small group of bulls are arguing the bottom will be August, September, and Bob, you want to buy growth in the fourth quarter. So they keep picking at tech stocks, some consumer discretionary stocks. Those are the ones that kind of are eliciting interest. But again, there's not a lot of, it's a long ways between here and the fourth quarter. Energy's doing a little better. Banks are doing better. They've turned around here. Just take a look. When was the last time you saw Citigroup lead the S&P 500? But it is. It's up about 5%. The bank stocks are up. That's nice. I just want to point out that yesterday, you see PNC? That's a new low. Yesterday, all the money center banks, all the super regionals were at 52-week lows. So yes, nice to see a little bounce here. But remember, yesterday, everything was at new lows in the banking sector. How about the earnings trends? This is very early. We haven't really gotten to any of the big industrials that I like to look at that's going to come in the next couple of weeks. But preliminary here, it seems very obvious to me. There's not as many companies that are beating estimates. They are not beating them as rates that are as wide as we have seen in the last couple of years. The commentary seems much more cautious. And preliminary, I'm seeing signs that finally the second half estimates are coming down. Let me show you some of the early numbers. Now, these are very early. There's 35 companies reporting. I'm including companies that have a May ending quarter. So it's a little larger group. But so far, 71% are beating the numbers. Last quarter, 77 were beating the numbers, 77%. The average beat rate is only 4.3%. You see, that's a very small beat rate compared to what we used to have in the last few years when it was 7, 8, 9, 10%. Last quarter was 8.9%. You see, they're beating, fewer companies are beating, and the percentage they're beating by is smaller. So again, I anticipate we're going to see those second half estimates come down. We've already seen in the last 2 weeks some numbers for the third quarter start to come down. As far as earnings today, I just want to point out BlackRock. There's a lot of chatter out there that somehow this is tremendously disappointing. I'll push back against this a little. It's true the headline numbers, profits down 22%, assets under management down 6%. Just remember, assets under management consists of how much you've actually got and what the prices are. With prices down 20% and 10% in the bond market, it's no surprise that the assets under management are down here. What you want to look here is long-term inflows of $69 billion, slightly below expectations, but institutional inflows still strong, and that iShares platform still keeps raking in money here. So the asset managers are down big this year. Everybody knows this, and the simple problem, of course, Carl, is that we're seeing the prices down, so the fees they can charge are generally to the downside. But overall, don't kid yourself. BlackRock, Vanguard, they're continuing to rake in enormous amounts of money. Carl, back to you.